GM, good morning. Welcome to the Milk Road Show, the daily crypto show that's as smooth as flipping the perfect pancake. I'm your host, Jay Hamilton. Today, we're joined by Kyle Reidhead, co-owner of Milk Road and head of research. In today's episode, we're talking about the Fed's decision to cut rates by 50 basis points. Fuck yeah. We'll be analyzing the market's reaction, the public's response. Is this bullish? Is this bearish? A lot of different opinions coming from both sides, and what we expect coming for the rest of this year and for next year, as the Fed gave a lot of information. Jerome Powell really broke down a lot of things around the economy and jobs and inflation and where he sees the economy going and what that means for rates, which obviously has a big impact on your bags. Now, before we jump in, if you hold some ETH, you might want to check out our friends over at Kelp DAO. Get ready because your reward farming game is about to level up. Introducing Gain, powered by Kelp, your DGen concierge. Gain is an automated vault launched by Kelp that maximizes rewards for ETH users. It offers one-click access to airdrops and points from leading L2s like Linea, Scroll, Karak, and more. Here's how it works. Head over to milkroad.com/Kelp Gain and spot airdrop Gain. Get a complete overview of how your assets are deployed and the rewards and points you stand to gain. With just a few clicks, deposit ETH or SETH or liquid staking tokens into the smart vault. That's it. The best part, once you deposit, you're issued a liquid token, AgETH, enabling you to participate in DeFi on Pendle, Spectra, Lyra, Splice, and others. Gain is already live and you can go check it out for yourself today. Just head over to milkroad.com/Kelp Gain and get started. Kyle, welcome to the show. Exciting show today. It's rate cut season, baby. Yesterday, we got the big news that the Fed cut rates 50 basis points. A bit blah, blah, blah at this point. Everybody knows that. What does it mean? Well, my favorite tweet, which I guess got to start off today's episode with, was this one from Douglas Bonaparte. He says, "Pilot on my flight home just announced the Fed rate cuts at 50.5%. Everyone started cheering, and the guy next to me said he's going to buy a rental property in Florida. We are so back."
I see you also have your yellow banana hat on, Jay. Are you? Is that your bullish hat, or did you need to do that?
I'm calling it, man. The banana zone. It's coming. It's coming. Watch out. You might miss it. It's going to happen. It's going to be fast.
Don't blink. Look, this actually couldn't have gone, I would say, any better. Do you want me to start breaking it down right now, Jay, or do you have something you want to
tee
up
up
first?
Yeah, I do.
Okay.
I do.
So this actually couldn't have gone any better, I think. I didn't expect it to go this way. I thought it was going to be 25 basis points probably. Most people thought if it went 50, it was because of panic, and that would be actually nuke the market. But it looks like Jerome Powell has literally done a beautifully soft landing. He's landing on a pillow right now, and it is amazing. But he's lowering 50% or 50 basis points and doing it in still a pretty healthy market all around. And so he's not doing it out of panic, which is what most people expected. He's doing it out of just, he feels he's able to do this to support the labor market, but not a big concern. So all in all, quite a surprise. I think everyone else who thought that it was going to be a 50 basis point cut thought it was going to nuke and going to be bad. And the markets have actually done quite well. And based on his speech, everything he said, which we'll get into, he's really nailing it, I think. So I'm quite impressed.
Before we jump into his speech and what he said about inflation and jobs and the economy, can you just give us a bit of context about how Jerome Powell has to approach this speech and how the Fed has to stick handle this?
Yeah, it's a tough position because so he's lowering 50 basis points, right? And if he's lowering 50 basis points because it's out of panic, then markets are going to absolutely nuke. And he obviously doesn't want that. He doesn't want people to think that he's doing this out of panic because he actually believes that the markets are doing well. But at the same time, he can't come out and be like, hey, I think everything's all good. We're great. Inflation's gone. Labor market's perfect. Like, we're cutting because we're just good to go. Like, send it. He can't do that because then people get too much confidence. Markets go through the roof, and then everyone gets confident again, starts spending. And then all of a sudden inflation actually comes back. And so, like, even though you could tell he believes the market is all good, and to me, the signal is bullish as fuck, he can't actually say that because he can't trigger a cascade of bullishness. He has to still make people believe like it's not bad, but it's not that good either. And so, like, he's got to thread the needle. And it's kind of funny to watch him and listen to him on what he's saying, because you can tell he wants to say things differently, but he's just very, very careful about what he's saying. So it's you got to really know what you're listening to when you hear him speak, because he's saying things and probably means things very different, I think.
Well, and that's why you listen to Milk Road, because we will make sure that we can translate what Jerome said into easy language for you. And I'm sure if everybody listening, you probably didn't have the time to go watch the FOMC press release, which I don't blame you. You're not in it every day like we are, but we are. So let's get into what he said around the different areas that are super important to us right now.
Yeah. So, I mean, the big news was basically he thinks the market is actually good. And so he's cutting rates to sort of support what's going on, not to out of like a reactionary thing, not out of panic, not because of recession, none of that kind of stuff. Meaning GDP is good, labor market's still pretty strong, inflation down. And so the first thing was inflation. You kept hearing him say, there's two words he kept saying: confident and recalibrate. Okay. Confident in terms of he feels very confident that they're going to reach their goal of 2% inflation over time. He didn't say it was going to be next month, but he kept saying over time. But he said the word confidence so many times. And so, we're currently sitting at 2.5% in the US, and he thinks we'll get to 2%. He didn't say when, but over time. And I think that makes complete sense. We've been saying inflation is not a problem for a long time, which is why we've been in the bull camp, even though most people have been in the bear camp over the last little while. And if you look at the chart we have up on the screen here, this is averaging out all the inflation cycles we've had since, I think, 1960. 1940, even better. And we're basically doing the exact same thing as it's always been, which is inflation spikes, and then it just comes back down. And sometimes there's some spikes in between that. It's not a straight way down. Same as happened this time, but it looks like the same inflation cycle we not always, but almost always have when you average it out. And so again, we've seen this chart. We showed this chart a lot last year when inflation was really a concern. And yeah, we couldn't agree more. We've been saying the inflation was not an issue for a long time. It sounds like Jerome feels the same and is very confident in that. And that's why he kept saying we're going to recalibrate our policy, where he didn't say we don't care about inflation anymore. Of course, they always do. Their two mandates are keep inflation at their goal, 2%, and then keep maximum employment. And so, but now I think they're more focused on the unemployment side of things, which then he jumped to and basically said again, he feels that unemployment or the labor market is strong. So he said he's confident in this. He's confident in the labor market. Doesn't feel like we're going to jump and have tons of unemployment. I mean, last month we were actually down versus the month previous. We'll still probably go up a little bit, I would assume, but we're currently at 4.2. But he just consistently said, we think the labor market is strong. We are not too concerned. Again, he can't be like, yeah, we're all good, everything's fine. He had to kind of jump around about it. But ultimately, he repeated multiple times that he feels the labor market's strong, and cutting rates now is just a way to support the labor market, but it's not doing it out of a reactionary way that like we need this to for the labor market to be strong. He says it already is. And so this new policy, this recalibration of policy, just supports that. And then the last part is about GDP, is about growth in the US, which he said multiple times. He thinks the US economy is strong. And it is. We've got a positive GDP. We've consistently had that. And so, look, he doesn't think it's the greatest market of all time, but he thinks that we are strong and things are all good. And so again, recalibrating, going into rate cuts is all good here. He sees no issues in doing that. It's just to further support the economy, further support the labor market. But again, nothing reactionary, which is all the things you wanted to hear and is exactly a soft landing. The fact that he's able to do a 50 basis point cut without recession, without fear and panic, pretty much tells you that this guy just did the soft landing. And we have not done a 50 basis point cut without a recession or without panic like COVID since we've only ever done it one time. So this is the second time in history we've ever done this. So it's actually pretty incredible what he's done here. Usually if we're cutting 50, it's because things are really
in a
bad.
Recession.
Exactly. And things are just not so bad. And so that was just great to see.
Yeah, the thing that really stood out to me is I think it's so easy. The whole world is still feeling a lot of the inflation effects right now because your day-to-day prices are still high. But we have to remember that lags by the time it reaches like retail and like groceries and things like that. It takes time. And so it's very easy to think like inflation is still a big issue. And if you talk to day to day, if you talk to a lot of like your friends and family, they might pump you up. And I even find that I'm like, oh shit, maybe inflation is still a big issue. But then you look at the numbers and you see that chart, inflation is fine. We're all good. And I think we couldn't be in a better place with where inflation is right now. I mean, I'm sure we could be in a better place, but we're in a very, very good zone. Kai, let's look at how did the market react to this? Let me first pull up the stock market equities. You can see here green across the board.
Yeah, as I said yesterday, you can't look at what the market's doing in the moment when it's announced because it's a shit show. If you looked the moment they did 50 basis points, everything rocketed up, then everything came back down, and then he started a speech and everything rocketed up again, and then at the end of the speech, everything came back down, and then by the end of the night, we were rocketing again. So it's like this is just the market, volatility. It is what it is. It's the next day or the next couple days is where you really start to understand what the market's doing. So far, waking up the next day, markets look really green. I mean, every single index in the US for equities, whether it's the Russell, the S&P, the NASDAQ, it's all up. Crypto is up everywhere. And so it looks actually really good, really bullish. I mean, we haven't seen this much green in quite some time. And so that is really nice. We talked yesterday about how we were at a bunch of support levels. We've bounced off all of them. And so it looks really good. When I went on Twitter this morning, everyone was so bullish. We are so back is what everyone was saying as you started the show. And I just want to do a bit of a reminder here. Like, we aren't actually back. Yes, it looks good and it feels good to finally have some green.
Guy, come on.
It feels good to finally have some green. It does. And obviously a 50 basis point cut, soft landing. This is all really good news. Like, I'm not bearish by any means, but all I'm saying is we are not out of the weeds yet because we are still just in the range we've been in for 7 months. In fact, some of them just got back into the range, which is like terrible, right? It's not like we're out of the range and it's like off to Valhalla. It's like we're still in the range. And so like, I'll show you just some examples here. So if you go back to sharing the screen, you can see this one I showed yesterday, which was the Bitcoin monthly. So for those who are listening, it's just looking at the monthly price of Bitcoin. We were sitting on support. We've bounced off. Great. We're still not out of this range that we're in here, this sort of like descending channel here, but we're still just in it. And so like, good, we've bounced off, and we bounced off very strong right off support this month, which is huge. But again, we're still in a range. This is Bitcoin again here that I'm showing. And we're in this range in the very middle of it. And look, we can go all the way to the top of this range, which would be 67,000. We have touched that 1, 2, 3, 4, 5, 6, 7, 8, 9 times in the last 7 months in this range. So like, we could easily go up to 67,000 and come right back down. And if we came back down to the bottom, we'd be at 57. Right? Or 56, depending on when we get back down there. So like, we're not out of the waters yet by any means, but obviously this looks good. But again, like, look at these 2 candles that we're seeing here. Like, this was a really bullish week so far. This is the weekly we're looking at now. But like, look what happened here in July. We had 2 massive weekly candles. Same with here in May. We had 2 massive weekly candles, and it always ended up coming back down and actually getting below that range. So like, are we there yet? Are we in banana zone? Absolutely not. When we break out of this channel, that's when the banana zone exists. And look, we might just shoot right through. I don't know, but we are definitely not there yet. And so like, I wouldn't be getting too excited. Solana, same thing. We hit off that support, as I said yesterday, but we're still just in this triangle. We're not out of it. We haven't broken out of it. And so we still need some time to get through it. For Solana, that would be about 151, 152. So we're not super far away from that. Again, about halfway. But if we can break through that and close and like maybe retest it, then okay, that's a good signal. ETH, same thing. Yeah, we bounced off that line I've been showing for a while now, and it looks good. The last time we bounced off this line was in October 2023, and we went from about 1,500 on ETH all the way up to about 4,000, which was 165% gain in a matter of like a few months, right? About 6 months. So like, maybe that's where we're at. It looks like it could be, but again, we're just off of support here. So like, I don't know that we are for sure. Now, the one nice chart that I really like to look at here is Tesla. Now, I've been bullish on Tesla for a while. We wrote a pro report about it before. Tesla's an interesting one because it's a tech play. So it's kind of like your NASDAQ. And if you want to think like your NVIDIA or even crypto, they kind of all move in a similar way. It's also in a downtrend, except Tesla also has a bit of the old economy in it because it's also a car company. And so car companies and old economy companies do well when we're in lower rate environments. And so you have sort of tech and this like low rate environment that does well for Tesla. And look at Tesla, it's just beaten through this like downtrend it's been in since 2021, which is insane. But it also has this inverse head and shoulders, which if it breaks through, this is actually nuts. This happens a lot with an inverse head and shoulders. You take the bottom of this inverse head and shoulders, take it to that trend line, and that's how high it's going to go in pretty much the near term. Coinbase did this last year. That would put Tesla, which is currently sitting at 241, up at 740. I can show you the same chart pattern on Coinbase from last year, and it did exactly this. It did the exact length that it said up to like 260 or whatever. That's what Tesla's about to do. So Tesla is an absolute beast, and it's just showing like, hey, if we're going to a rate cut cycle, like it's on. And so anyway, nice to see Tesla finally getting above that. That's a good sign that risk on is coming. because if Tesla's pumping, that means good things. And again, I can open up this. Here's all the crypto that I have that I'm watching. Here's all the stocks. Everything is just huge numbers right now. It's a lot of green. The other good thing that I didn't show yet is all the things that could have happened well yesterday. Stocks up, crypto up, whatever. Dixie, so the dollar down. Great. And then gold, all-time highs. And then the USD yen, which is the thing that everyone's been scared of. Look at what it did. I have no idea why, but it absolutely skyrocketed higher, meaning safer, much better. Because if it went lower, that was scary about the yen carry trade, which maybe we're just past that now. But either way, we went all the way up to 143, which it was like below 140 was the scary moment for that. And so everything that could have went well yesterday, it all happened.
Oh, I love it. I love days like this. This is the best. This is the best. But I appreciate your fresh dose of perspective that we are not in the banana zone yet. We are still in the range. Super important. What else was amazing that came out of yesterday was the rest of the rate cuts that are coming. Let's just take a look at that. So not only did Jerome Powell say that we're going to cut 50 basis points right now, he said that they are going to do 2 more cuts this year of 25 basis points is their plan. That would be November 7th and December 18th. And then 4 more cuts in 2025, followed by 2 more cuts in 2026 for a total of 8 rate cuts still to come. Kyle, what does that mean?
Yeah, so Powell didn't necessarily say this. This is just the expectations of all the Fed officials when you look at the dot plot. And so expecting at least 50 basis points more lower this year. There's only 2 left. And so either one of them will be a 50 or they'll be 25 and 25. And then, yeah, as you said, 4 next year and then 2 and 26. Look, these will change all the time. And so like, I wouldn't expect this is exactly how it's going to play out. But basically what they're saying is that's 2.5% lower than what they were yesterday, right? So we were at 5.25, I believe is what the Fed funds rate was. And so we're basically going down to around 2.5. And so that's a big difference, right? It's basically cutting what we're at in half. Now, if you look at past cycles, we almost always continue to just cut all the way. And so I don't know that it's going to happen, but since like 2008, when we finally cut after the big crash, the great financial crisis, we went down to almost 0. I think if you hover over at the bottom there, we're like 0.25 or 0.10 or whatever. Yeah, 0.2. And then again, 2016, we started raising, 2017, 2018. This was COVID, so it's a bit different, but we went down again to like 0.1 or 0, I guess, for a while. And now I don't think we go back to 0. And Jerome Powell said he doesn't know how low we'll go, but I would assume we're going down to at least 2.5. 2.5 is what they've said. So probably it's going to be lower than that. But we'll obviously have to just see what happens with the market, how things go. But I think what this means is, look, over the next 18 months, as the Fed has basically told us, we are going to ease. And so rates are going to come down. And what does that mean for us? I mean, first, it means that everyone right now who's been in a bit of a pinch because of their mortgage or because, people aren't hiring as much or like it's just tough when rates are high. It's harder to get a car. Your car payments are more expensive. Your house is more expensive, et cetera, et cetera. Everything's just going to get a bit easier for everyone. So like, yes, markets are going to do very well over the next 12 to 18 months. We're going to hit that banana zone, I think. We can talk about that in a second. But just in general in life, I think what this means is like the next 12 to 18 months, finally, after a tough last few years, let's call it, things are just going to get easier. Everyone's businesses are going to start doing better, right? You're going to start to get more sales depending on what you do. Your costs are going to go down, especially as inflation goes down too. Gas has head down much lower over the last little while as well. And so like finally, and again, this doesn't happen today. We're down 0.5, but it's not a massive yet. But over the next little while, things are just going to consistently get easier. And as a result of that, the market's going to get better and prices are going to go up. So everyone's going to feel a bit richer for the next 12 to 18 months. And that overall is just a good thing. What's going to go up the most? How's the market going to do? Like, we don't know that for sure, but we definitely know that when we're in a rate cutting cycle over the next 2 years or however long we end up doing it for, life's going to get a bit easier for everyone. I think that's just going to be really nice. So I'm excited for that.
That sounds so nice. That just sounds swell. But it's true. You can't underestimate that. It's been tough. It's been tough for financially on individuals, on businesses. Everybody has been feeling the pinch. And yeah, it's nice to have some relief finally. Kai, when we step back, other than the great relief that is coming, what else could be the impact of this and future rate cuts?
So there's a few things. So as rates go lower, not just do we have, our expenses go lower so we can buy more things, which is just nice for the growth of the economy. It's nice for, of course, investments, et cetera. But if you think of what happens here, there is a lot of capital that is in treasuries, right? So they're just getting yield because it's been 5.25%. That's pretty damn good. Why invest in the stock market hoping to get 8, 9, 10%, which is the average for most, when you can just have no risk and just put your dollars in a treasury at 5.25, right? You're a couple percentages off what you might get as the average in the stock market, and you basically have zero risk. And so a lot of people just put their capital there. As rates go down to 4 or like 4.5 and then 4 and then 3.5 and then eventually 2.5, as they've said already they're going to go to, well, 2.5 isn't that great because inflation is already 2, and we all know it's actually a little bit more than that. And so like most people don't want to hold a treasury when it's at 2.5 or 2 or even lower, depending on how low we go. And so at that point, where does that capital go? There's trillions of dollars in treasuries right now. And look, not all of that moves. Some of that is there for a reason, but a bunch of that moves to equities or into crypto or into gold or into whatever that may be. And so again, times are going to get easier for everyone in terms of our expenses, but also capital just has to move out of treasuries because the yield just doesn't make sense anymore. So that's one thing of why we go risk on when we start to see rates lower. The other thing that's interesting is when we have rates at 5.25%, you don't really need the yield that you can get in crypto. Staking yield isn't that cool anymore. Like getting your 3-4% on ETH isn't that big of a deal when you can get 5.25% on your dollars. And so what happens is as rates go down, right, more capital gets interested in the yield you can get from other things, right? The yield you can get from, let's say, real estate, buying real estate and then renting it out. That's a yield, right? Or buying ETH and staking it, buying SOL and staking it, etc. Or using DeFi, because you can get a lot of on-chain revenues that provide real yields from things happening on-chain. Like Athena, for example, their yield comes from basically open interest, right? So the more leverage in the system, the more yield is created. The more, if you hold their stablecoin, you can get yield. It doesn't matter about rates. And actually rates going lower means there's probably going to be more leverage in the system, more open interest. And so you'll probably get higher yields over on Athena. Maker, same thing, right? Maker gets its yield from people taking out leverage, taking out loans against their ETH or against their Bitcoin or whatever it is, right? And so those yields get higher and higher as real rates in the real world go down. And so what happens here is more capital is probably going to come on chain because it's just the only place to get yield. Now, again, it depends on how low we go in treasuries. Like if we sit at 4%, probably not much is going to move. But when we get to 2.5, 2, whatever, that's when a lot comes in. And that's kind of your tail end of the banana zone. Because that's everyone, especially the last movers, like, oh, why am I holding my money in this bank account giving me 2% when I can go over here and get 5, 6, 7, 8%, right? So that's all coming. Again, it won't happen right away, but slowly that's going to happen month over month over month. And so again, I paint this. This is the banana zone in action. This is why the banana zone happens. As rates go down, as more liquidity comes in, they're looking for yield, they're looking for returns. And right now, probably on-chain is going to be the best spot for that as rates go lower.
Yeah, on-chain is the best spot for it. You heard it right here. Okay, so I think my final question is, what do you think as an investor? How are you acting right now? What are you watching over this coming week? And where do you think we go for the rest of this year?
With Zeneca last week or 2 weeks ago, we said there's sort of 2 check boxes we need to check here. One was lowering rates, make sure we got that under, and that's a big green check. This worked out much better than we thought. 25 would have been great, but it's the fact that we could do 50 and still be bullish is huge. So it's a big, thick green check in that box. The next box is the election. So we are, I don't know, a month and a half out from the election at this point, and markets still don't like uncertainty. And so there's still a lot of uncertainty on what's happening with the US, what's happening with Kamala Harris. Is Trump going to get it? Like, we still don't really know. And this more matters for, I think, the tail end of crypto. Probably for Bitcoin, it doesn't really matter. For ETH, for all the alts, like, I don't think we get altcoin season, even though, I mean, alts have done quite well just today. But I don't know that we get the altcoin season unless Trump really starts to run away with it. But like if Trump gets elected, it's pretty confident like Gary Gensler's probably out, and we have a whole new regime that comes in and sets good regulation. I mean, Trump's launching a DeFi project and a token, like insanity what's happening over in that world. And then it's like, we don't know what happens with Kamala Harris. She's backtracked her thoughts around like taxing unrealized gains and all this stuff that she's done, but a lot of things that markets don't love. And so the big green light is if one, just the green check is election over. I don't care who wins. That's a good thing. But for altcoin season and big banana zone, it's like Trump winning, because then I think it's like finally Uniswap turns on its fee switch, right? And like the lawsuit against Ether right now or against Lido around calling staked ETH a security, that goes away, right? All the things that are currently suppressing ETH and alts and crypto in general, most of those go away. Now, maybe Trump's lying and we don't know for sure, but I'm pretty confident that like it alleviates a lot of pressure. And so like you remove that, you remove the gravity basically that's what's holding it all down. And like that is your alt season right there. And so we're a month and a half away from that. So again, probably things do well over the next month and a half, I would say, coming up to that election. I don't think they do super well. But as I said yesterday, they probably go higher from here. And then depending on what happens in the election, that's the last green check we need. And then it's basically just game on because we already know what the script is. We need liquidity and rates are going to go lower, as we've said, for the next 2 years. So it's very much game on. And this chart you have up on the screen here of like part 2 of the bull run is very much what happens post-election, in my opinion.
Do you think we see volatility for the rest of September, or do you think we get into October early?
It's a good question. Until we're out of the range, I'm not overly bullish. Like I don't use a lot of leverage anyway, but I would use leverage if we got out of that range. I think it makes like it's a time that you would start to use it, but I wouldn't use it now. I think there's still very much a chance we could come back down to all of these support levels that I've shown at the start or at yesterday. We could easily go back to these. So I think we'll definitely have volatility leading into the election because who knows what will happen. I mean, Trump almost got assassinated again last weekend at the golf course. So like, who freaking knows in the next month and a half. And so we really need November 5th to come and go. And then we can finally, I think, just like take a deep breath, exhale, and just like let markets rip.
No, we never take a deep breath and exhale. We just keep on going and keep on pushing and stressing and enjoying the ride. Kai, thanks so much for leading us through today's episode. Everybody listening in, I want to know, are you bullish right now? Are you feeling good as a result of this 50 basis point cut? Are you worried? What are your fears? Let us know how you're feeling in the comments, and then we can make sure we respond to those questions and help you understand where we're going from here, because we always do our best for you guys. Thank you so much for listening, and thanks for joining us again. Have a wicked awesome day. As always, if you liked today's episode, please hit subscribe and make sure you follow us so you don't miss out on the next one. There's also a link in the description to our free 5-minute daily newsletter where we simplify crypto for you while making you laugh. And if you're willing to step up your crypto investing game, we're going to also leave a link for Milk Road Pro. You get access to our portfolio where you can see exactly what we are buying. This is your #1 resource to help you invest successfully in crypto. One final note, this show is for educational purposes only, and nothing we say is financial advice. Investing in crypto or any asset is risky, and you should never invest more than you can afford to lose. Thanks so much for listening in, my friends. Have a wicked awesome day.